Next on our list is Pick n Pay, which I said earlier it had its results out today. Of course, it's a Western Cape-based retailer, the Ackerman family. In recent years, it's kind of built out the Boxer brand as well. It went through a bad patch about 6 or 7 years ago, but under CEO Richard Brash, it's done amazingly well. I must concede, I called this one very badly wrong in recent times. It's grown to a market cap of 33.8 billion rand, price earnings ratio 30.92, so that's higher, but it's delivering the earnings growth. You'll see in a minute. Dividend yield of 2.16. How did the results today look to you?
Good results, in line with the trading statement, and I think that's why we've seen the stock re-rating as much as it has.
Because it's trading at all-time highs now, I think.
Very close to, but 26% increase in revenue, and that will of course unwind the PE quite quickly. So a 31 PE seems quite expensive, but when you have 26% earnings growth...
You're right, because that was probably calculated on the numbers prior to these ones coming out.
So your forward PE looks a bit more valuable.
But I mean, when I say I called it wrong, is that my sense was that 5 years or so ago, they were losing market share to ShopRite. They had distribution centers that were in disarray or non-existent. They had bad payment systems. They didn't like their suppliers, and their suppliers didn't like them. Staff was a problem, notwithstanding, years of trying to be a very liberal employer. Their employees seemed to hate them. There were constantly strikes, bad environment in the stores. Well, anyway, Richard Brash seems to have fixed all of that.
He definitely has. So I think there's 2 parts to this turnaround strategy, and that first part was having a look at the distribution and the back end, and they definitely seem to be on the right track.
Massive distribution center out there at Longmeadow, servicing the whole of the Gauteng area, so it gives them the ability to have many more stores. They don't have out-of-stock problems. And
it brings down your cost of sales, most importantly, which of course helps your margins. And I think the investment community is really keeping a close eye on that margin to judge the success of this turnaround strategy. But what concerns me is the second part of this turnaround strategy really relies on top line growth and on seeing further sales growth. And I'm just a bit concerned about the local environment and whether they will be able to achieve that top line growth and to continue helping that margin.
Let's have a look at the share chart, because I think what you can say there is this one has been a steady uptick, but there have been moments, particularly there in the second half of 2015, where there was a bit of worry about whether the sales growth and the profit growth was back in track, but now it seems to have been restored. I guess what you're saying is that they've done, well, I don't know about the easy part, but they've done the part that was in their own control, and now it's going to be a little bit harder.
And they really are relying on the consumer and the health of the consumer going forward. So I'm not too hot on this one.
Okay, that's interesting. So now I'm in a quandary, because I've called it not hot forever, and now it's gone up so much. I don't know, I just think if you read the tone of the message and you go through all of their descriptions and all of their attempts to go into different formats and so on, I think they're doing more right than wrong. So I'm going to lean hot, but that's fine. I understand where you're coming from.